Ever pondered what mysteries your best book might be concealing? If you could just go back in time, could you see the most important historical events? Do you believe that your knowledge of the cosmos is exhaustive? What if I told you that some of the wealthiest individuals had a secret that helps them achieve all they have? Have you ever wondered why you feel so fantastic after eating a certain food? If you unexpectedly found yourself in a survival situation, how would you respond? Have you ever had the impression that someone is listening to you on your smartphone? What if all you believed to be true about success was false? Come along with us in this video as we explore these fascinating topics and find the fascinating solutions that will have you watching all the way through. Number 10. Net worth. In the context of a corporation or an individual, the term net worth refers to the amount of money that the company or person worth financially. Calculating the value of the assets that are possessed and then subtracting the value of the obligations that are owing is one way to establish this value. Given that the net worth of a firm provides a concise summary of the company's present financial state, businesses utilize this statistic to evaluate the health of their organizations. You are able to apply this mathematical idea to individuals, corporations, particular industries, or even countries. In addition to book value and shareholders' equity, the term net worth may also be used by experts in the business world. The net worth can be either positive or negative, according to the professionals in the financial industry. A negative net worth indicates that the individual's liabilities are greater than their assets, while a positive net worth indicates that the individual's assets are greater than their liabilities. If your net worth is increasing, it shows that your financial health is good. However, if it is decreasing, it may imply that your assets are decreasing in comparison to your liabilities. The term high net worth individuals refers to people who have an extreme amount of positive net worth. Number 9. Inflation. Throughout a period of time, the purchasing power of a certain currency decreases, which is referred to as inflation. Inflation also refers to the persistent rise in the prices of products and services. Your ability to afford the same items reduces when the cost of goods and services grows, which means that your money has less purchasing power when inflation is higher. Professionals who are currently employed might take into consideration the fact that their employer is increasing their compensation or salary in relation to the rate of inflation. Inflation is primarily caused by a rise in the money supply of a country. However, the value of a currency can also be affected by other variables. Consumer Price Index and Wholesale Pricing Index (CPI) are the two primary indices that are utilized by experts in the financial industry in order to ascertain the rate of inflation, because an increase in inflation signals an increase in the value of physical goods. Individuals and businesses who possess tangible assets can reap the benefits of an increase in inflation. Number 8. The liquidity. When we talk about liquidity, we are referring to the ease with which we may convert assets into cash or the availability of that money. Cash is the asset that is considered to be the most liquid of all assets, while tangible objects are considered to be less liquid due to their physical nature. As an illustration, real estate is typically not very liquid because it takes time to achieve a certain level of value, and it may also take some time to sell these assets. For the purpose of assessing liquidity, experts in the financial industry may employ the current ratio, the fast ratio, the acid test ratio, or the cash ratio. Both market liquidity and accounting liquidity are considered to be the two primary types of liquidity. The ability of a company or an individual to fulfill their financial obligations in the event that their debts become due is referred to as reporting liquidity in accounting. In the context of a market, such as the real estate market, the term market liquidity refers to the degree to which assets can be bought and sold at prices that are open to public scrutiny. Because of the lack of liquidity in the market, it is difficult for sellers to transfer their assets into cash form. Number 7. Bear market. Bear markets are characterized by a market that is experiencing a decline, which is characterized by high unemployment and dropping share values over a protracted period of time. When the market is in a bear market, investors have the opportunity to buy equities at cheaper prices and hold them until the market recovers. It is possible that many investors will sell their shares during this period in order to convert them into assets that are more liquid, such as cash. Number 6. Bull market. An increase in stock prices and a low level of unemployment for an extended period of time are two indicators that point to a bull market, which suggests that the market is showing signs of improvement. It is generally accepted that a bull market is an indication that the economy is doing well. Nevertheless, while judging the health of a market, financial professionals take into consideration a wide range of indicators. Investors are eager to purchase securities in these markets, which results in a market that is favorable to buyers. Keep in mind that markets are in a state of perpetual flux, which means that a bull market or a bear market does not necessarily last for an indefinite amount of time. Number 5. Asset allocation and diversification. In the context of an investment portfolio, asset allocation refers to the process of classifying various assets into several categories, including equities, fixed income investments, cash and cash equivalents, futures, and alternative assets. The diversification of assets into a number of distinct asset categories is an essential component of an investment plan, and one of the most significant aspects of this approach is the allocation of assets. A risk tolerance can be better managed with this method, which also has the potential to improve overall investment goals. A portfolio that is more diverse may be indicative of reduced risk and may result in a greater return over the course of a longer period of time. Number 4. Risk tolerance. The level of risk that an individual is willing to absorb in relation to their investments is referred to as their risk tolerance. The level of comfort that an individual has amid economic fluctuations, such as a bear market, is reflected in their risk tolerance. Investors that have a high risk tolerance generally make investments with bigger stakes in the short term. People who have a poor tolerance for risk typically invest for a longer period of time and receive a lower return on their assets. There is a strong correlation between an individual's age and their level of risk tolerance. This is because younger people may have to wait longer for a return on their investments. In addition, those who have a higher net worth and a greater amount of discretionary income are more likely to take more risks in their investments because they have a higher risk tolerance. Number 3. Simple interest. A payment for making use of capital is referred to as interest. When interest is calculated on the principal part of a loan or the initial payment to a savings account, this type of income is referred to as simple interest. The amount that borrowers are allowed to charge for financing a lender and the amount that an investor can gain by purchasing an asset are both included in this consideration. It is because of this that the interest does not compound, and the lender simply pays interest on the initial amount, rather than on the interest that has accumulated over time. The interest is often calculated by lenders as a percentage, which reflects the amount of money that the borrower requests from the lender in exchange for the use of their capital. In order to calculate simple interest, you must first multiply the yearly interest rate expressed in decimal form by the number of years that the loan will be in effect, and then you must multiply this number by the principal amount. For instance, if you take out a loan for $40,000 over a period of 5 years at a rate of 3.5% each year, you can determine that the interest on the loan will equal to $7,000. It is possible to calculate simple interest using the following formula. The simple interest rate is calculated by multiplying the principal amount by the interest rate divided by 100 times the loan length. Number 2. Compound interest. It is possible to compute compound interest not only on the original amount, but also on the accumulated interest that has been accrued on that principal amount. Unlike compound interest, which causes the annual interest amount to fluctuate, simple interest does not affect the amount of interest that is accrued each year. An example of this would be a savings account with a principal of $100 and a compound interest rate of 10%, which would result in the account earning $110 in the first year and $121 in the second year. Number 1. Capital Asset Pricing Model, CAPM. In order to determine the value of investments based on the anticipated rate of return, professionals in the financial industry utilize the Capital Asset Pricing Model. The model analyzes the connection between the risks that are associated with assets, specifically equities, and the projected return on those assets. If you enjoyed this video and want to dive deeper into more fascinating topics, don't forget to hit that subscribe button and turn on notifications.